Welcome to today's Explainer. We're putting on our advisor hats today to cut right through the absolute deafening noise of the modern financial landscape. Think of this as a complete audit of the market to figure out what's real and what's just hype.
Because let's be real for a second. How do you actually protect your wealth when the market feels like it's totally spinning out of control? I mean, you've got TikTokers promising 10x returns on your tax refund, which, by the way, is completely absurd, massive opaque shadow banking networks, and these alarming geopolitical headlines constantly threatening global supply chains. It's overwhelming. But listen, don't worry. We're going to break this down step by step to separate the financial illusions from reality so you can actually make decisions based on facts, not just fear.
First up, let's tackle avoiding modern financial illusions. You have probably seen wild claims exactly like this popping up all over social media lately regarding prediction markets. Influencers are hyping them up as this highly sophisticated way to trade the news with an insider edge. They'll point to a headline about a political event, buy a contract, and claim it's basically a guaranteed win. They pitch it as investing for the modern age. But honestly, you're essentially just betting on a coin flip wrapped in really fancy financial jargon.
And the data completely backs that up. When we look at independent blockchain analysis, it is a massive reality check. A staggering 84% of retail users on these platforms actually lose money. Let that sink in. Only about 2% make more than $1,000. When you're betting on a binary event where even a quote-unquote sure thing carries the risk of 100% loss, you're not investing. You're walking into a casino. It's a negative-sum game for the average user, heavily favoring just a tiny fraction of professional arbitrageurs.
And it's the exact same story with this relentless push for prop trading and copy trading as your ticket to financial freedom. The pitch is always the same. Just pass our trading challenge, we'll give you a massive funded account, and we'll split the profits. Sounds amazing, right? Well, here's the reality. Those firms don't actually make their money from successful traders. They generate the vast majority of their revenue from evaluation fees paid by users who inevitably fail those strict, often totally unrealistic trading challenges. It's a business model literally built on your failure, not your success.
All right, moving to part 2, let's step away from retail speculation and unmask some of the hidden risks operating behind the scenes in institutional finance.
So, post-2008 financial crisis, traditional banks were hit with massive new regulations, right? They had to step way back from risky corporate lending. Enter private credit. Think of it as a giant shadow banking system. Bypassing the traditional bank middleman sounds incredibly efficient, but it also means bypassing traditional safety nets. These investment firms raise capital, lend it directly to private, non-publicly traded businesses, and pass the returns back to investors, minus some pretty exorbitant fees, of course.
And we are talking about a massive, largely opaque market that has exploded to roughly $2 trillion in the US alone. $2 trillion. And it's super alluring. Private credit funds have historically offered really attractive yields. When traditional bonds were paying next to nothing, an historical 9.8% annual return was an absolutely irresistible pitch for institutions, and now increasingly everyday retail investors. But well, cracks are definitely starting to show. You see, a lot of these private credit loans have floating interest rates. That means as the Fed keeps interest rates high, the monthly payments for these borrowing businesses absolutely skyrocket, and companies are buckling. We're actually seeing corporate private credit defaults jump from 8.1% in 2023 up to 9.2% in 2024. That surpasses even pandemic-era highs. Companies are staggering under the debt load, which is leading to sudden, massive write-offs.
So what happens if investors get spooked by all this and try to pull their money out? Well, often they literally can't. Private credit loans are highly illiquid. You can't just sell them on an exchange in 3 seconds like a stock. To prevent a panic, funds enact what's called gated redemptions. Think of it like being in a crowded theater and management locking the exit doors so everyone doesn't trample each other trying to get out at once. It protects the building, sure, but it traps you inside. Now, experts agree this isn't a systemic 2008-style meltdown, but it is a very stark reminder. Illiquid assets can lock up your cash exactly when you want it most.
Okay, part 3. Let's completely strip the emotion out of these massive global economic headlines and just look at the raw data.
Let's start close to home with domestic infrastructure. Take the newly proposed $25 billion Canada Strong Fund. It's a sovereign wealth fund that really appeals to retail investors wanting to patriotically build up the domestic economy. On the surface, that sounds fantastic, but underneath, it carries massive risks. It's proposed to be a concentrated, heavily illiquid, Canadian-only private asset fund. If those projects face regulatory delays or huge cost overruns, retail investors could be left holding the bag on a highly concentrated, non-diversified bet. Or take the headlines toting a massive $23.6 billion fiscal surplus if the province of Alberta were to separate from Canada. Objectively speaking, economic reviews show that math relies on some incredibly aggressive and frankly flawed assumptions, like commandeering federal pension returns, while completely ignoring the costs of being landlocked. If we look at post-Brexit data, non-tariff barriers increase trade costs by up to 8%, a reality that would absolutely wipe out billions in GDP annually. The loud political noise really masks the basic economic math here.
Shifting over to the Middle East, this really shows why we have to look past the panic. Whenever there's conflict involving Iran, headlines immediately scream about the Strait of Hormuz shutting down, threatening triple-digit oil prices globally. But look at the structural data. Did you know alternative routes already exist? Saudi Arabia and the UAE have actually built millions of barrels of pipeline capacity directly to the Red Sea and the Gulf of Oman, specifically to bypass that exact strait in a worst-case scenario. And what about this idea floating around that the U.S. is just going to swap out Canadian oil for Venezuelan crude? The structural reality tells a completely different story. To actually rebuild Venezuela's severely neglected oil industry, you'd need over $100 billion and a solid decade of work. Right now, massive U.S. energy firms consider that region practically uninvestable due to hostility and instability. You just cannot replace structural supply overnight, no matter what a headline says. Plus, the physical infrastructure literally just isn't there to support it. 78% of Canadian oil exports flow straight into inland U.S. refineries. Those refineries were built specifically to process oil coming from southbound pipelines. They simply do not have the logistical setup to accept tanker-shipped heavy oil coming from Venezuela up through the Gulf Coast. The logistics just do not support the panic. So, with the illusions busted and the headlines decoded, let's get to part 4, synthesizing all of this into your actual actionable investment game plan. Think of this as your advisor's checklist to protect your wealth. Number 1, diversify globally. Never bet your entire portfolio on one single country or sector. Number 2, truly understand liquidity. If you buy into private funds, you have to be prepared to have your money locked up for years. Number 3, always maintain a liquid emergency cash fund so you are never forced to sell assets during a market panic. 4, ignore short-term geopolitical headlines and trade on structural reality. And finally, number 5, avoid gamified finance. If you have to pay a fee just to prove you can trade, you are the product, not the investor. So I really want to leave you with this one key question. Take a step back today and look at your overarching financial strategy. Tune out the daily panic, log out of the prediction markets, and honestly ask yourself, is your wealth structured to weather both the hype and the headlines? If you found this explainer helpful, make it a point to review your own asset allocation this week. Thanks so much for auditing the market with me today. Stay focused out there.